Hello, welcome to our first screencast in the series Ratios to Know. These casts are being put together for small business owners to be able to look at the financial statements they've been presented by their accountant and interpret what some of those figures actually mean. Today we're going to take a look at the current ratio. The current ratio is one measure of liquidity which is used pretty extensively by your banks and creditors, so it's an important thing you should know about your own balance sheet. It's also very easy to calculate yourself at home. Just a quick word on ratio analysis. Ratios tend to fall within three categories: liquidity, solvency, and profitability. The current ratio is a liquidity ratio, which means it's looking at our short-term ability to pay our debts as they fall due, with a little bit of a cushion for any unexpected things which may pop up. The current ratio, as we said, indicates our short-term ability to pay debts. The calculation is very simple. Current assets divided by current liabilities. Okay, so you're home from the accountants and you've been presented with a big bound bundle of various financial statements. Depending on your industry, there might be a trading account in there, a manufacturing statement. I'm sure there'd be a profit and loss. What you're looking for is your statement of financial position, previously known as your balance sheet. Now, originally when I mocked up this example, I actually used a rather large public company, but that's not very realistic for small business. So what I've done here is I've just pulled up a local Central Coast retailer. He's been trading for around 12 months, and this is his actual balance sheet. We're interested in our current assets and the current liabilities. Looking at them more closely, we can see that he has assets made up of cash, some debtors, a bit of stock, and other things there as well. Those other things are actually prepaid borrowing expenses. His liabilities are made up of some creditors and some tax liabilities. We're interested in the total current assets, and we're going to divide that by the total current liabilities. This gives our retailer a current ratio of 3.55. What does that mean? A current ratio of 3.55 means that for every dollar of current liability, our sample company has $3.55 of current assets. Now, norms are a little bit dependent on what industry you're in. You'll find that the retail sector often have lower current ratios. Generally, a ratio of 2.0 or above is considered reasonable in most areas. High ratios, on one hand, might indicate a strong financial position. However, they can also be masking other problems: slow collections, stock which is sitting on the shelf and not moving very fast. So the current ratio, simple as it is, does have real-world limitations. It is only one measure of liquidity and should not be used in isolation. It is susceptible to very quick changes, highly influenced by the timing of transactions. Generally, we'll use year-end balances, which might not be current at other points throughout the year. Let's have a look at what I mean by that. So we said that our current ratio is susceptible to quick changes and the timing of transactions. Let's take a look at how that might work in the real world. Our retailer here has decided to take $100,000 of his cash and pay that to his suppliers. What this has done, it has decreased his current assets by $100,000. It has also decreased his current liabilities. His current ratio is now 8.64. That's quite a difference from 3.55. In another example here, we can see that adding equal amounts to both the numerator and the denominator is going to cause our ratio to decrease. For instance, if we were to obtain $100,000 of additional stock and we were to purchase that on account from our creditors, we have increased our current assets by $100,000. We've also increased our current liabilities. This has decreased our current ratio to 2.53. So to recap, we can see that it is only one measure of liquidity. It is susceptible to timings of transactions and some pretty quick changes. It's taking a snapshot of your figures at a particular point in time, that would be balance state, and it also doesn't take into account what your assets are made up of. I, for one, would much rather have $1 of cash than $1 worth of slow-moving stock. And that's it from us on our first cast on Ratios to Know. Join us next time where we're going to take a look at the asset test or quick ratio, which considers the makeup of those current assets. If you have any questions or you'd like to know more, feel free to get in touch with us on 1300 35 22 35.